What's the difference between ETFs, mutual funds, and index funds? Each of these things are different types of investment products, but their terms get thrown around a lot and are used interchangeably. It gets very confusing understanding the differences between them. But the problem is that we're not taught this information in school, but it can have huge ramifications on how much money you have when you retire, depending on which of these three investment products you choose. Personally, I've been investing in ETFs, but I've since realized that ETFs don't have two really important features for my particular investment strategy. So now I'm actually planning to transfer over to index funds, which is actually quite challenging. Now, I don't want you to make this same mistake. So in today's video, I'm going to be talking about the pros and cons of mutual funds, index funds, and ETFs, so that you can be fully informed on each of these different investment products when you go to make an investment decision. If you want to learn more about the difference between mutual funds, ETFs, and index funds, and which option might make sense for you, then keep watching today's video. Before I get into these explanations, please hit the subscribe button. My channel is around investing and saving money for beginners. I know it's going to help make your investing journey easier and build long-term financial independence. So let's start off with mutual funds, which are the oldest of these three investment products. Mutual funds have been around for a really long time, and the first mutual fund was actually created over 100 years ago. Mutual funds were created for investors to easily buy into a diversified fund of stocks without having to buy each of these stocks individually. Mutual funds are therefore really convenient for investors because it means that you can buy in a single investment a basket of lots of different stocks. And mutual funds typically consist of at least 100 stocks. An example of a mutual fund is if you went onto Vanguard's website, scrolled down and clicked on their managed funds list, such as their Vanguard Active Global Growth Fund or the Vanguard Active Equity Emerging Market Fund. If you were to invest in one of these funds, you would be buying into a highly diversified fund that consists of many different stocks, including Tencent Holdings, Alibaba Group, Samsung Electronics, and the Taiwan Semiconductor Manufacturing Group, just to name a few. If mutual funds didn't exist, then you would have to buy each of these stocks individually. If you wanted to buy a portfolio of 100 different stocks, then you would have to log into your brokerage account and make 100 individual trades for each of those stocks. This means that you have to pay thousands of dollars in brokerage fees because you're still getting charged trading commission on each individual order. You'd also be spending a lot of time during work hours sitting in front of your brokerage platform, which I'm sure your boss wouldn't be happy about if they saw you spending hours and hours on your trading platform buying these individual shares. But if you were instead going to go with a mutual fund, then you get access to all of those individual stocks that the mutual fund owns, which effectively gives you ownership to hundreds of shares. This gives you great diversification in a single investment. Diversification is extremely important for any type of investment strategy and gives your investments a long-term security because it simply means you aren't putting all of your eggs in one basket. It's like if you had the money to invest in property and buy lots of different investment properties. Obviously, you wouldn't go and buy 10 investment properties all within the same area because there's always going to be a chance that that particular area could end up being a bad place to live, causing the value of your investment properties to go down. Instead, you would buy multiple different investment properties all throughout different parts of the city or even throughout the country. As a result, you're not putting all of your eggs in one basket, and the overall value of your total property portfolio wouldn't go down if just one of those areas that you had invested in became a bad area to live. So instead of having all of your money just in one single stock, like the mistake that I made with Slater and Gordon, buying into a mutual fund gives you access to hundreds of individual stocks, meaning that if one of those stocks plummeted in value, then the overall value of your investment wouldn't go down by very much because you'd have 99 other stocks which are still okay. And by spreading your eggs out across multiple baskets, this also means that the chance of all 100 stocks that you're investing in and falling to zero goes down by a lot. The second advantage of mutual funds is that they give you great diversification in a single investment. So because they typically consist of lots of different stocks, you don't have to buy each of these stocks individually. With mutual funds though, they are actively managed by an investment professional who buys and sells shares on your behalf. It's supposedly someone who's highly qualified and educated in investing, who selects the individual stocks for you to own on your behalf. This is what we mean by active funds, because an investing professional is actively choosing each of these individual stocks for you to own on your behalf. Mutual funds are almost always actively managed funds. So by investing in mutual funds, you're also investing in an active money manager who is taking responsibility for the overall fund on your behalf. But the problem with mutual funds is that these investment professionals do not come cheap, and they typically charge about 1 to 2% per year of your investment. This means that if you invested $10,000 into a mutual fund, you would have to pay at least $100 per year in management fees. And you would still have to pay that fee to the fund manager, even if the performance of the mutual fund goes down. Like, let's say if you invested $10,000 into a mutual fund and it actually goes down 5% in its first year. Not only would the value of your investment drop to $9,500, but you'd also have to pay that $200 in management fees to the fund. And so the fund manager still gets paid millions of dollars for their service, regardless of the performance of the actual fund. Now, fund managers will always claim that these sorts of active management fees aren't actually that important. And the reason why they claim this is that you should always instead look at the overall fund's performance. Typically, they will claim that they can get you the best possible investment returns, even when you take into account the huge fees that they charge, because they can deliver for you 20%, 25%, or in some cases, even 30% average annual returns. And if you compare that to the performance of the stock market overall, which typically returns on average about 8% per year, then on paper, yes, it makes sense to go with someone whose returns are a lot higher, regardless of the fees that they charge. But even if a mutual fund manager can show you that they have delivered these sorts of historical returns, and therefore in turn your net returns after their fees would still be better than the overall performance of the stock market, there's absolutely no guarantee that they'll be able to achieve those sorts of similar returns in the future. I'm going to cover this in more detail in another video, but there's a lot of data and research which shows that over the long run, mutual fund managers who actively pick and select stocks for investments don't end up achieving better performance than the stock market in the long run. This means that if you went with a mutual fund that has delivered high historical returns, it's highly unlikely that this type of historical performance can be replicated over the long term. And the cost of their active management fees really add up as well. Over the years of paying 1 to 2% in active management fees, this is really going to reduce the bottom line returns and the overall retirement nest egg, and can cost up to hundreds of thousands of dollars. And this was actually one of the major findings by the Royal Commission into the Australian banking sector, which basically found that superannuation funds were charging huge amounts of management fees, which couldn't actually be justified because they were only able to deliver either similar returns to the overall stock market, or even in some cases underperforming the stock market. And this meant that investors were potentially losing out on thousands or even hundreds of thousands of dollars by the time it came to their retirement. So for the most part, justification for investment in mutual funds isn't the best in my opinion. And for me personally, it just wouldn't make sense to go ahead with a mutual fund despite all of the professional advice, because at the end of the day, no one has any idea where the value of a stock is going to be in the future. This is why index funds came along in the 1970s and were invented by the founder of the Vanguard group, Jack Bogle. Basically, Jack Bogle decided that he was getting sick and tired of these mutual fund managers charging really high fees for their so-called professional services, and realized that people could instead get similar returns by instead investing in index funds, which don't have any active fund managers and therefore have much lower management fees. Index funds are a whole new category of mutual funds, and they completely revolutionize the way people can invest by providing people with the opportunity to invest in the indexed performance of the stock market. This provided investors with the opportunity to get higher returns than actively managed funds, whilst also at the same time having to pay lower management fees than actively managed funds. Index funds are passively managed, meaning that instead of paying high fees to a fund manager, the index fund just instead follows a fixed formula that just simply tracks the overall performance of the stock market, therefore eliminating the need for someone to have to make buy and selling decisions on the investor's behalf. Index funds track an index. An index just basically means a representative sample of stocks that make up an overall stock market. And it's usually just the collective value of the top 100 to 500 companies that are listed on a particular stock market. In America, the most common stock market index is the S&P 500, which is a collective sample of the top 500 publicly listed companies in America. And in Australia, the most common index is the ASX 200, which is a collective sample of the top 200 companies that are listed on the Australian Stock Exchange. And this is why you see people refer to the All Ordinaries or the All Ords when they talk about the performance of the stock market in Australia. Price of the All Ords is represented by a single number, which as of last week was 7,702. Now, this single number effectively represents the combined weight of the top top 200 companies that are listed on the Australian Stock Exchange. And there are many other indexes across all international stock markets, including the Nasdaq, Dow Jones, Nikkei, and Hang Seng. These indexes were effectively created as a tool to look at the overall performance of an individual stock market. So rather than having to look up individual companies like Commonwealth Bank, BHP, and Woolworths, you can instead just look up the All Ords to see how the stock market performed overall on that day. The first index fund that Jack Bogle created mirrored the S&P 500 index and was the first fund that was made available to investors. Funnily enough, it wasn't actually well received by the professional investment industry, but since then has been praised by Warren Buffett. In fact, Warren Buffett made a $1 million bet in 2008 with the investment management company Protege Partners, and he bet that the S&P 500 would outperform any active management fund over a period of 9 years. And he was right. Over 9 years, the S&P 500 index delivered a return of 85% from 2008 to 2016, whereas the best actively managed fund only delivered a return of 62%. And that was the best performing actively managed fund overall. There were all these other actively managed funds which only delivered a return of 8.7%, 28.3%, 2.9% and 7.5% respectively. This means that if you invested in any of those actively managed funds, your performance would be so bad. And in some cases, you would have even lost money because you would have to have paid those huge actively managed fees. Buffett has also famously said that the best thing to do is to just simply buy and hold the S&P 500 index forever. And that's largely because the fees are so low and you're not paying for a professional to actively pick and choose certain stocks for you. The investment group Vanguard has an index fund which tracks the S&P 500, which is the Vanguard Fund Admiral Shares, or VFIAX, and has a management fee of only 0.04%, which is peanuts. You can't buy into this fund as an Australian investor, but if you did want to buy into a simple index fund which gives you exposure to the broad US stock market, then you can buy the Vanguard US Total Market Shares Index ETF, or VTS, which has a management fee of 0.03%. Now, to understand the difference between mutual funds and index funds, you'll need to understand that index funds will just say on their product disclosure statements that they simply just track a stock market index. If you look at the investment products on Vanguard, you will see that some of their products have active in their title, whereas others have index in their title. For the most part, this means that you may be buying into an indexed or actively managed fund. And you will also see that the indexed funds have much lower management fees than their respective actively managed fund counterparts. Just bear in mind though that index funds are technically a type of mutual fund. So technically all index funds are mutual funds, but not all mutual funds are index funds. So for example, if you looked up the Vanguard Australian Shares Index ETF, or the VAS, you will see in their product description statement that the VAS ETF simply tracks the performance of the ASX 300, and it meets those investment objectives by holding the same number of shares as the ASX 300 index. Now, the ASX 300 index is supposed to provide Australian investors with a broad exposure to the Australian stock market. But if you buy into a mutual fund, then the product disclosure statement won't say this. The investment product disclosure statement will instead say something along the lines of, the fund uses multiple investment advisors, and each advisor independently selects and maintains a portfolio of common stocks for the mutual fund. These sorts of product descriptions should allow you to tell the difference between an index fund and an actively managed mutual fund. Now, we finally have ETFs, or exchange traded funds. ETFs were introduced about 15 years after the creation of the first index fund. ETFs are very similar to index funds, with the difference simply being that ETFs are effectively just a single stock that represent a index fund, meaning that you can buy and sell ETFs really whenever you want. Index funds, though, aren't necessarily available to buy as a single stock. You basically have to set up an account with Vanguard or any other investment company in order to buy into an index fund. And that means that you can only buy and sell into index funds once per day. Since ETFs aren't technically an index fund, they are technically tradable as a stock. Now, Vanguard does use the term index funds and ETFs interchangeably, but they aren't technically the same thing. So for example, if you wanted to invest into the ASX 200 index, you could either go with the Vanguard Australian Shares Index Fund, which again means you have to set up an account with Vanguard, or you could instead buy the Vanguard Australian Shares Index VAS ETF. And you can do this by simply searching for VAS and buying it on Commsec or any other Australian brokerage platform. You can buy as many shares of this ETF as you want. Investing in either the index fund or buying ETFs is, for the most part, essentially the same thing. Again, really, the index fund is something that you need to buy through Vanguard, whereas the ETF version, you have to log into Commsec and buy as many shares that represent that particular ETF. This also means that since ETFs are basically stocks, you would also see the value of that ETF change every single day whilst the market is open. So really the question that you need to ask yourself if you're deciding between whether you want to buy index funds or ETFs is whether you want to see the value of your investments fluctuate on a day-to-day basis, or whether you're happy just leaving your investments alone altogether and only checking in every couple of weeks to see how your investment is going. Despite the advantage of being able to trade ETFs more frequently, it doesn't really give you any distinct advantage over index funds when you're looking to set up a long-term investment strategy. And in my experience, constantly looking up the price of an ETF just results in more impulsive investing and gambling. So why would you even bother with this sort of temptation when the whole point of index funds and ETFs is a long-term investment strategy? That is buying and not selling your investments for at least 2 to 5 years. But if you are new to investing and don't know where to start, then perhaps ETFs are a better alternative. And that's simply because they are a lot easier to buy. You simply just look up their stock code on Commsec or any other brokerage platform and then buy and sell them as a single stock. But this does mean that you will have the temptation to sell them if they do go down in value. If your investment strategy is longer term, then you probably are better off going ahead with investing in index funds. Most people should really just be buying, holding, and then selling when they go to retire, meaning that you don't need that tradability of an ETF. The other advantage of index funds over ETFs is that they allow for automatic reinvestment of dividends that you receive. The whole point of these investment products is to consistently reinvest any dividends that you receive from the investment products back into the investment itself, causing the investment to increase in the long term. And index funds will reinvest the dividends automatically for you, whereas ETFs don't do this. With ETFs, you still get paid dividends, but you're the one that actively has to buy more ETFs with those dividends that you receive. This also means that you need to pay more and more money in brokerage fees every time you go to buy more ETFs with the dividends that you receive from those ETFs. And overall, these brokerage fees will start to add up in the long term, causing the overall value of your investment to decrease as well. Since index funds automatically reinvest the dividends for you, you don't have to pay individual brokerage fees. Investing in ETFs also means that since you actively have to reinvest the dividends back into those ETFs, you are spending more and more time on brokerage platforms having to actively manage your investments. Whereas with index funds, since they do this automatically, it's really just a case of set and forget. And since the whole point of both of these investment products is a long-term investment strategy, index funds therefore offer this distinctive advantage. That being said, if you are planning to sell your ETFs within say 2 to 5 years, then they may be a better investment option for you. I really hope this video helps you understand the differences between mutual funds, index funds, and ETFs. Mutual funds were the first of these 3 investment products to come first, and in my opinion, they should pretty much be avoided at all costs because they charge really high management fees and there's absolutely no guarantee that they'll be able to outperform the performance of the stock market overall. Index funds came along later and instead they just mirror the performance of a particular stock market index, which for most cases is a representative sample of the top 100 to 500 stocks on a stock market. They offer much lower fees because of their passive management and for the most part perform just as good, if not better, than mutual funds. ETFs for the most part are basically like index funds, except they're represented by a single stock that you can buy. All 3 investment products are well diversified though, but over the long run, index funds offer the most advantages because they allow for the automatic reinvestment of dividends, whilst at the same time not having to constantly pay trade commissions. ETFs, on the other hand, are a lot lot easier to buy because they're simply just represented by a stock code that you can buy through any brokerage platform. It also means that you can consistently monitor their performance through that brokerage platform and sell those ETFs whenever you want. If you've got any more questions about mutual funds, ETFs, or index funds, then please just leave it as a comment below and I'll be sure to get back to you. And remember to subscribe to this YouTube channel so that you can be the first to get updated whenever I upload new content on finance and investing. Thanks for watching.